Okay, before we start this week, for the applied level and sector studies, you will note that healthcare sector is up. It was posted last week, so we have an overview of the healthcare sector, about 45 minutes there. And then understanding pharmaceuticals, I broke it down into three parts: manufacturers, distributors, and the pharmacy benefit managers, the PBMs. So 3 hours on manufacturers because it lays out a lot of groundwork. You need this to sort of understand distributors. But once we understand that, distributors really are easy to get through, 25 minutes there, and pharmacy benefit managers, 33 minutes there. But the understanding, to understand distributors and PBMs, you have to go through manufacturers first. Where am I going next? I'm going to industrials. That seems to be the heavier consensus, is to head to industrials. There are three groups in industrials: capital goods, services, and transportation. Here are the weights. Capital goods are 66.5% of industrials, services 15%, transportation 18.5%. Here you'll find trucking companies, airlines, marine, things like that. In capital goods, the two biggest sub-industries, machinery and aerospace and defense, with machinery being the biggest one. It's 21.5 of the 66.5. So if you're doing industrials and going after the big sectors, industrials, capital goods, machinery, I'll be using DEER and CAT. And here, there's things you have to know about capital goods before you can understand machinery. So that's what you'll get next. That's what I'm heading to next. I'm already well into it. I don't know when I'll be done. I never know when I'm done these things. Usually they take about 3 weeks from beginning to end to the time I have the video. They take about 3 weeks to do these deep dives. So that's what's coming up next. And then I'll go on to communications, and I don't know what I'll do in communications, but I'll figure it out when I get there. Let's have a look at our nominal yields. Money market rates, normally well behaved, but starting to price in cuts. If you go out to the 6-month and the 1 year, they are starting to price in some probability of rate cuts. And on the long end of the curve, we had some rallying in bond prices. The 7-year down 21, the 10-year down 17, under 4.5, now 4.44. The 30-year 4.59. I think that the bond market would have had a better week if it wasn't for the odd reaction off of PPI, which was inconsistent with the data. So I looked at the PPI report to see, well, is there anything inside it? Negative signs in a lot of places. So the reaction was inconsistent. So I'm led to the conclusion that there must have been a seller that needed to sell and wanted to sell into strength. And the PPI gave them the opportunity to sell into strength. It was deflationary. Okay, now's the time to sell because it should be a well-supported market. We're not going to drive prices down too much. It should be well-supported. That would be consistent because the price action on the release was inconsistent with the data. Slopes, 2 to the 10, inverted 44 basis points, a small little change. Basically call that unchanged week over week, but still inverted. For the 3-month to 10-year, the money market, the capital market inversion, now triple digits again in basis points, 106 basis points inversion. That was a fairly big move, 14 basis points. Canada is more inverted, 79 on the 2 to the 10, the capital market inversion, and the money market, the capital market inversion, 135.6. This is becoming interesting over here. The Fed balance sheet, the SOMA down another 30 billion to 7.1944 trillion. Based on runoff, we're not going to see a 6 handle probably till late January, early February, but we will see a 6 handle on that in the next 8 to 10 weeks. Look at the balance sheet, is 7.814 trillion versus 7.86 trillion the week before. That's a drop of 45.7 billion. The SOMA was 30.5. Another net runoff on the balance sheet of 15.2. So you're getting a contraction in their balance sheet from SOMA, from the runoff of the securities, and more runoff over here. Well, I wouldn't call it runoff, but reduction in their balance sheet over here as well. Money market funds increased. This surprised me given the rally in the market and the benign level of inflation. And the widespread belief now that the Fed is done, there are no rate hikes. From here on, the question is, how long are we going to stay at this level before rates drop? And there's another growing belief that inflation is actually going to drop faster because there is a deflationary backdrop that we're going to get back to. And if that falls faster, real rates will begin to rise unless there is a cut in nominal rates. Right, because it is your nominal minus your expected inflation, which equals your real rate. So if nominal rates stay the same and inflation just keeps dropping, your real rates will continue to rise, which will continue to tighten financial conditions. So there may have to be rate cuts just to keep the real rate constant, just to keep monetary policy from becoming way too restrictive. So this seemed odd that there'd be an increase in money market funds. Yes, you are getting a nice return on the 1 to even up to the 4, well, all the way out to the 1 year, really 5.4 to 5.5%. But you have to sort of wonder, could you do better on the long end of the curve with duration if you think that there are going to be, well, SOFR futures are pricing in 100 basis points of rate cuts. UBS has been even more aggressive with their thinking of where rate cuts are going to be. It just seems surprising that there would be an increase given the data last week that there probably would be better places to be, like duration. Retail up 10.5 billion, institution up 11.4 billion, with both government and prime increasing on both. December 13th, FOMC, 24 days away. Look at that probability over the last week. 100% probability that nothing's going to happen. There's no waiting on a rate increase at all. That went from 91% to 100% over the course of the week. If we go to June, there is a 17.7% probability that by June nothing will have happened. No rate hikes, no rate cuts, but 82.3% probability of some rate cuts, whether it be 25, 50, or 75, there is some probability in there, versus 60% the week before. There was a 40% probability that rates would stay the same or go higher by June. That's gone. There's nothing here, nothing here. You're down to 17.7 on nothing. From 40 down to 17, and from 60 up to 82. November 1st, we get the minutes from the, not November 1st. We get the November 1st minutes in 2 days, on Tuesday. Normally you get them on Wednesday, but Thursday, the U.S. markets are closed. Friday, they close at 1. So we really only have 3.5 days this week. Monday, Tuesday, Wednesday, Friday's not that much of an exciting day overall. Canadian CPI in 2 days. On the economic calendar next week, Monday, leading economic indicators, and we have a 20-year bond auction. The 20-year is it's an odd tenor. It has a very specific clientele. So it's not, I don't know that it's market moving, but let's just be aware there's a 20-year bond auction. Tuesday is the 10-year tips. Wednesday, durable goods and Michigan consumer sentiment. And that's it. Thursday's closed. Friday's a shortened day. Effective federal funds rate still sits at 5.33%. Look at reverse repo, still continuing down. November 10th was 1.03 trillion. November 19th, 935 billion. We can start getting rid of the T's and start putting B's in there now. A drop of 97 billion. The lowest level the reverse repo hit last week was 912 billion on November 16th. The lag, if we think in terms of 12 months, effective federal funds rate now is 5.33. 12 months ago it was 3.83. So 150 basis points left to be felt. So when the Fed says, now it's a matter of how long do we stay at this level. It doesn't mean that the economy is not going to feel higher rates. If there is a lag, then there are, at the margin, every day some people whose debt resets at higher rates. So for them, rate increases are still on the horizon. Another 150 basis points to get rid of a 12-month lag. Real rates last week have all pulled back. And remember, next year we have the 10-year TIPS auction. So we'll see if it comes in at the whatever the real rate is. We'll see if it clears at whatever the real rate happens to be at that time. Break-even rates have all come down, which is consistent with the data that we have seen. This is where some interesting things have happened. The Fed funds futures, it's flat right out to February with slight move in March. But all 94.67, implied rate 5.33, which is where the effective federal funds rate is now. And November, December, January, February, there is no expected change in the federal funds rate, 5.33. Going out to June, it is now 94.94, implied rate of 5.06. Last week it was 5.195, a drop of 13.5 basis points. The difference between end of February and end of June is 27 basis points, implying that somewhere in Q2 you're going to have a rate cut. I say somewhere in Q2. This is February. This is June. It could be anywhere within there, which could mean it's March, but it just doesn't seem like the market is thinking much is happening in March, that it's somewhere in Q2. Going out to the end of September for Q3, 95.19, a rate of 4.81 versus 4.96, a drop of 15 basis points. That is an exact 25 basis point cut somewhere in Q3. And looking at SOFR futures, December 24 over December 23, 98 basis points. So Q2, Fed funds futures is pricing in one rate cut, it seems. Q3, it's pricing in one rate cut, and Q4, it looks like we're pricing in two rate cuts for a total of 4 rate cuts over 2024. Morgan Stanley is forecasting 12 rate cuts by the end of 2025. This is 4 by the end of 2024. They're saying 12 by the end of 2025, so another 200 basis points over 2025. Goldman Sachs, 8 rate cuts by mid-2026. So they're thinking, nah, you're not going anywhere. 8 rate cuts is 200 basis points. So you get from 5.5 down to 3.5% by mid-2026. 12 cuts is 300 basis points, so you'll get to 2.5 by the end of 2025. UBS, far more aggressive, 10 rate cuts by early 10 rate cuts in 2024. In 2024, by early 2025, another 6. 16 rate cuts, 400 basis points. They think by early 2025, the Fed funds will be somewhere around 1.5%. But 10 rate cuts, 250 basis points over 2024. The market's pricing in 4. UBS is at 10. I can't tell where Morgan Stanley and Goldman Sachs are, because Morgan Stanley just says he gives a target by the end of 2025. Goldman gives a target by mid-2026. But I think we can say maybe they're probably consistent with the futures here in pricing in 4. UBS is far more aggressive at 10. Let's look at TLT. Up 2.33% last week. SPY up 2.24%. There is CPI. That was, in my mind, the right reaction. That sort of cemented in the idea that, you know what, inflation is coming down, and the Fed truly is done. They are done. I don't know that there's very many out there now that would say, oh no, they're going to push higher. They're definitely going to push higher. I think the debate now is for how long. It's the how long part, but the how high part I think is over. Now we're on the how long. So we're in phase 2 of this. This is the odd reaction here. PPI on the release, it was nice. yields dropped, bond prices went up, and then it, with conviction, went straight down. So there was selling. There had to be selling for that to happen. And I think that being that the move down was inconsistent with PPI data, because we can see later that, okay, well, by the next day we had recovered what we had lost. It was inconsistent with the data, so I think that there might have been a significant seller who was waiting for strength to sell into strength. And when you had a good report that suggested that now's the time to move into duration, as you have lots of buyers coming in, that's when you want to time your selling, is when you have a supportive market. Yes, you pushed prices down, but you didn't push prices down, like way down, had you sold into weakness. So the PPI report had some strength. If you were going to sell, you always sell into strength. You're still going to push the price down, but nowhere near where you would push it down at any other time. You want buyers coming in. I think, being that I couldn't find anything else going on and I could find no fault with the PPI, that's what I felt it was. The only other argument that I can make is that, well, this was way too much. Based on what the CPI report was, that was too much. It was just too much. But then PPI had negative numbers. I don't know why you would see the negative numbers and say, okay, that was too much the other day. PPI is just not showing it. PPI is showing negative numbers everywhere, so that didn't quite fit. So I think there was a seller. And then Friday morning was nice, and then you had some selling again, but you had buying coming in at the end of the day. We're finishing, TLT finishing over $90 now, from a low of, I think we hit at one point mid 83s, so up almost 10% in that short time. Implied volatility disappearing as well, a 13-week down to 34% from 51. Okay, 30-year fixed rate mortgage, coming down slow. Only 6 basis points, down to 7.44. Treasury dropped 17 basis points over that period of time, so the spread has increased 11 basis points to 299 from the 30-year fixed rate to the 10-year. So, when you think about agency mortgage-backed securities, you've got a de facto government guarantee in there. That's attractive, 300 basis point spread. I just am wondering when the market is going to pick up on that. It is unanchored really from housing prices, because it is, if you're buying agency, you are getting that de facto government guarantee on it, so it wouldn't matter to you really where housing prices are, but housing price index is up. If you look at Case-Shiller or the housing price index itself, year over year, it's up. Mortgage apps for end of November, November 10th, for the week ending November 10th, up 2.8%, even at these mortgage rates. This is a big hit. The housing market index, the National Association of Home Builders, 34. This is a diffusion index. Anything under 50 is contraction. So last year we saw it go from 30s all the way up to 56, and then all the way right back down. We're right back down again. The forecast here was for 40. The previous read was 40. It's at 34, which is at odds. This happens in the first few weeks of November, and this is October's data. That you would think coming off of October there'd be more positive sentiment with the home builders. Building permits up 1.1% month over month. Housing starts up 1.9% month over month. So it seems a little bit at odds, unless there's something in here. Let's see if we can make a story. Perhaps sentiment is dropping significantly because sentiment is related to the level of activity, but mortgage apps are here, right? Showing that there is activity, but maybe they're just not seeing the sales. Maybe they have to keep lowering their price to get the sales, and that's dropping their sentiment. But they're still building houses, just they're not very happy about the houses they have to build. Maybe that's the story. Tuesday, we get existing home sales for the month of October. And agency up 3.57, annually 4.7, which is consistent. Look at the REITs, IYR up 4.49. Prologis for distribution, 5.28. Digital Realty for data centers, up 4.49. The home building ETFs, XHB 6.31, ITB 5.73. Look at all the home builders up significantly, quite a bit. You would think that these are tech stocks the way they move around, especially this small float guy over here, ABR. ABR, disappointing on ABR, another short report on ABR. And it's not, it's a scam report again. From Viceroy. I had already put up a video about it. These are people with very questionable character that take information. It's not so much that the information they tell you is wrong, it's that they distort the information. So let me give you an example of distorting information. Let's say that it's raining outside, and everybody can look outside and see that it's raining. And everyone has adjusted their clothing and their dress for the day and their mode of transportation and their behavior for the rain. In other words, it's priced into people's actions already. It's raining. So me saying, putting out a report saying, well, it's raining, is of little value, right? The value was in forecasting the rain coming. But when I see the rain, and everyone can see the rain, and I put a report out that says it's raining, there's no value in that. But there is truth in it. There is truth in the statement that it is raining. What I need to do is distort the truth. So I have to say that this rain is going to make all the farm fields in this area unplantable for the next 5 years. And that the value of farmland is worthless because of this rain now. That the farmland is going to be buried under rain for the next 5 years. The value is worthless. And here's a company that holds a lot of farmland in the region. So people can say, well, the report says it's raining, and it is raining. Yes, it's the distortion that's the key. It's not the fact, it's the distortion that is the key. And that's the type of report that Viceroy is very famous, or notorious, I should say, for putting out. Is not that they're telling you something you probably don't already know. It's not that they're telling you something that everyone hasn't already priced in, much like everybody adjusting their behavior for the rain. We say they've priced in the rain. It comes in the distortion of what that is. So they point out the obvious and then they distort it. Okay, let's have a look at CPI and PPI. PPI is over here. Look at this. For goods, this is negative right here, about negative 1.33, halfway through, negative 1.35, negative 1.4, and their services just under the zero line. Call it zero. But PPI had, if you went into the different stages and the different indexes for final demand, negative numbers everywhere. For CPI, all items, headline, zero. But, you know, let's just be a little bit cautious here. Last July 2022, the CPI that came out for June also had zero. And that's when Biden, I don't know if you remember, whispered into the microphone, there's no inflation, folks. It's gone. There's no inflation, folks. And he whispered it so that very few people could hear in the microphone. He does that quite a bit. But we've seen it before. We've seen it go to zero before. So, you know, let's just remember that, hey, it's done this before. But it did it like this, right? You know, it hit zero and then it had a rebound. Then it came lower than where it was before. But, you know, it doesn't mean that it can't do this. This will cause some grief if it starts to do that again, because nothing ever just does this, but it does this kind of thing, right? Energy, well, for the headline, energy was the big one. Look at all those big negative numbers. So the core is 0.2, which is not a high number. 0.2 is well within the range of where the Fed needs to be. Vehicles, both new vehicles and used vehicles. Used vehicles took a big dump, and they've been going down for quite a bit. Negative 1.4, negative 1.2, negative 2.5, negative 0.8. They just keep dropping. And new vehicles down 0.1. Housing, if we look at rent of primary residence, has been flat at 0.5. That's rent. Those are rents that you can look at. The next one is owner's equivalent rent. Is more volatile, 0.5, 0.4, 0.6, 0.4. But it is coming down, 0.5, 0.4, 0.6. You know, we're at the lower part, the 0.4. It'd be nice to start seeing a 0.3 in there. Coming down, but it is volatile. We get PCE later this month. Look at hospital services, 1.1%. This does not have the weight in PCE. CPI is a basket of goods, and it's just tracking the price of the basket of goods. PCE tracks the price of a basket of goods that consumers actually pay for. Since they typically don't pay for hospital services, since health plans pay for hospital services, those things aren't included in PCE or have an extremely low weight in PCE. So something that was extremely high here, 1.1, not really in PCE. And shelter has about half the weight in PCE that it has in CPI. So I don't think that PCE is going to derail the disinflationary story that we're seeing right now. Forward 4-quarter operating earnings, IBES 235.95, down slightly from last week. SP Global 233.26, down slightly from last week. This has sort of been the trend for the last 4 or 5 weeks now, is that the forward 4-quarter earnings are dropping. Not a lot, but they're going down, not up. Closing SPX 45.14, so 19.24 on the multiple. And sitting below the July high, somewhere just below 460, sitting at 450, another 100 points, and you're printing new highs. Currently above the 50, above the 200, and above the trend line being the downward trend line here, sitting above the trend line, but below the July peak. That's your next point of resistance. We're at an initial point of resistance here. Once you break much above there, you start closing at 454, 455. Then you're looking at the highs. Here is the problem. Here's the limiting factor. Operating earnings keep dropping. Not by much, but they're going in the wrong direction. They're coming down every single week. So higher prices just result in higher multiples, which means the market can only get more expensive from here. Now, when I say more expensive, I don't mean the price of the market. I mean the price of the market for what you're getting. You're getting the value being your estimate of what the forward earnings are. So you're paying for value. You could pay a high price but get a lot of value, and your dollar per value would be low. That would make the price cheap. Even though the dollar value is high, the value is even higher, making the price cheap. But here we're in a situation where the value each week just keeps dropping a little bit at a time, but the value keeps dropping, but the price keeps going higher, which means this market can only get more expensive. What you want is a situation where week after week, estimates of earnings keep increasing, which means you can have a price that's increasing even at a slower rate, and you'd have a market that's getting more inexpensive. Do you get that? Because value is increasing faster than price, the market's actually getting more inexpensive as it goes up. That is capital B bullish on that one. What we have here is we have a technical bullishness, is you have price momentum, but you don't have value momentum going on. You have value sort of creeping down each week with price going up, which means the higher we go, it just means the market's only getting more and more expensive. This multiple is increasing. What you would like to see is the market going up and the multiple not moving, or the multiple even decreasing. The market getting cheaper as the price is going up because earnings are expanding faster, or the estimate of earnings are expanding faster, but they're not. They are creeping downwards. Creeping. They're not dropping off a cliff. They're creeping downwards while the price is moving up. This market can only with this pattern, the market from here on in can only get more and more expensive. And as it gets more and more expensive, there are fewer and fewer buyers and more sellers over here. So this becomes a very difficult level to breach unless the estimate of earnings starts to increase, which then makes the market cheaper at that price. But even if the market stayed flat where it is here, and we look next week and these were down even more, the market would become more expensive even if the price didn't go up. If the value dropped and the price stayed the same, right? So this is not the conditions for a strong bull market. That doesn't mean you can't rally. It just means that it's going to be expensive for you to participate. You'll be buying the market at an expensive price, meaning a higher and higher multiple. Still, doesn't mean it can't happen. Just be aware that, as Warren Buffett says, price is what you pay, value is what you get. Price is what you pay, meaning you'll pay this over here. Value is whatever estimate of earnings you're going to get. And if they're coming down and you're paying more, you can see that that's the wrong direction. Earnings this week, Tuesday, Best Buy, Lowe's, Analog Devices. And then this is before the market opens. After the close, HP and NVIDIA. That is on everybody's radar. This is the AI rally. Does it continue? I don't know that this quarter has been one in which NVIDIA's sales of its GPUs would be hindered very much. Yes, you have other design firms that are designing their own GPUs and contracting them out to fabs to get them done. In time, there will be other GPUs. NVIDIA's story is not a secular trend for NVIDIA. It is a short-term story until the buyers have developed their own GPUs. So it is just a matter of time before their story is over. I don't think it's this quarter, but it is just a matter of time. And then Wednesday, you have Deere. And that will do it for the week. Oh, one more point I want to bring up is, and I'm sure you've heard it all week long, Tesla, mostly Musk. Actually, one thing with Tesla, one thing with Musk, and his comment. I don't think I need to tell you what his comment was, but it's causing all sorts of concern. Advertisers are leaving X, and some owners of Tesla stock are saying, I want out, and some owners of Tesla vehicles are saying, I want to get rid of my car, and some are canceling their orders because of his comment on a post that was conspiratorial. Let's just say that without throwing words around. And I think that people have a point. You're the CEO of a company. Maybe you have an opinion. It is not okay for you to share that opinion because you're sharing that opinion on behalf of all your investors. You cannot do that. You have to mind your mouth. If you have investors, that means other people are relying, have risked capital and are relying on you, especially when you're the figurehead CEO, which you are. It's not as if I said the name of a company and who's the CEO and it's like, I don't know, it's because they're boring. He's not boring, but he does have a responsibility, and he just seems to be shirking that responsibility. So now you have calls for his removal from Tesla. That those calls are starting to grow, that he should step down as CEO of Tesla because he is ruining the brand. Even though he said something over on X and acting as an employee basically on X, he is affecting the brand, and there is calls for him to step down. So let's see how that plays out. He has defenders just as much as he has people that would like to see him step aside at this point. As far as Tesla, November 30th is the truck delivery date, and the latest information out is that 10 trucks will be delivered that day to employee buyers only, to limit the amount of damage that potentially could happen, because they're not certain whether or not it's built solidly enough to be putting into the market. So there will be a slow drip of these coming out, but employee orders, from what I'm reading, employee orders will get filled first, and only 10 will be delivered on November 30th. And we've already seen last week some pictures of it, and the Cybertruck has been spotted in the wild a couple of times, and I guess there was one questioning the brake lights because the signal light and the brake light are the same color, so that when you're signaling and you hit your brakes, you can't tell that you're hitting your brakes because it's the same color as the signal light. And then there was another one showing a truck carrying a Christmas tree, and it's sticking way out of the end of the truck, demonstrating how small the box in that truck actually is. So I think personally the truck is going to be the thing that hurts them the most. I don't think it's based on everything. It just doesn't seem like it's ready to go into production, but they just can't seem to delay it anymore. After delaying it for 4 years, they kind of have to get it out there. I think that's going to hurt them quite a bit. And given the sentiment growing around Musk to step down on Tesla, a misstep on a product launch, along with his willingness to engage in conversations he shouldn't even be a part of, is 2024 the year where Tesla goes ex-Musk, right?